Hi, I'm Professor Brett Frinberg from the Griffith Tax Clinic here at Griffith University. In this presentation, I'm just going to talk about working from home and what some of the potential tax deductions you may be able to claim. Firstly, I'd like to make an acknowledgement of country. Griffith University acknowledges the traditional custodians of the land that we're meeting upon, and we pay that respect to elders past and present. And we extend that respect to all Aboriginal and Torres Strait Islander people. So what I'm going to discuss here is some of the possible deductions that you may be able to claim when working from home. Now, normally, where we live is totally private in nature. And so the expenses, whether we own or rent our home, are not tax deductible as a general rule. But if we're regularly working from home as an employee, then some of those expenses related to that work may be tax deductible. It can be known as a home office. But let's see exactly what is deductible. Because of COVID-19, many of us are now working from home and we can't work from our boss's normal place of employment. Because of that, the ATO has brought in some special rules that apply for employees working from home between 1 March 2020 to 30 June 2020. And essentially those rules, special rules, essentially say, look, work out the number of work hours that you've worked at home and just times that by 80 cents per hour. Now that 80 cents is basically an estimate of the possible expenses that you may have incurred because you were required to work from home, such additional expenses. They could cover a multitude of things. So that 80 cents covers things like lighting and electricity for your home office, the cost of cleaning your home office, some of the office equipment that you need to purchase, repair costs for that, the office consumables, and software. This 80 cents covers it all as an estimate. And for many of us, it's quite generous, because maybe your work has provided you the laptop you need. And so really your running expenses for your home office may be more in relation to the electricity, maybe your internet expense and telephone calls, but the 80 cents will cover that all. If there's multiple people who are working from home, then each of those persons are their own individual taxpayer, and each person could claim this 80 cents if they're working from home. And so they'll claim that individually in their own tax returns. However, your actual expenses, the additional expenses that you've had from working from home may be actually higher than this 80 cents per hour estimate. And if you think your actual expenses are higher, you can use the standard rules in terms of your deduction for working out a home office. I'll cover that in a separate presentation, those standard rules. So it's optional for you to use this 80 cents. And if you want, you can use the standard rules. So some of the things to think about is that this 80 cents per hour only covers the time that you work from home between 1 March 2020 and up to 30 June 2020 currently. And so you need to record the number of work hours at home during this time period. Don't forget to allow for any annual or sick leave that you've had. So i.e. you weren't working for a couple of days in those couple of months. Also, if there's public holidays and weekends, and so you haven't worked on those days. Once you've worked out your number of work hours from home, just times that by 80 cents per hour. You'll then claim your tax deduction for this in your 2020 tax return. In your 2020 tax return, you'll just note that you're using the COVID hourly rate. Please make sure you keep a record about the number of work hours at home, because as a taxpayer, the onus is on you to keep those records, and your estimate must be reasonable. So please keep a diary. It can be a paper diary or it can be an electronic diary in terms of how you've worked out your number of work hours from home. You might have already been working from home sometime between 1 July 2019 to 29 February 2020. In that time period, you can use the standard rules about working out your tax deduction for working from home. As I said, I'll cover those standard rules in a separate presentation. You could use those standard rules for the whole year in terms of what is your tax deduction for working from home. So if you want to see what those standard rules are, please watch the next presentation about that. But remember, the 80 cents per hour only applies from 1 March 2020 to 30 June 2020. Getting a tax deduction is great, but if you get able to claim a tax deduction of $100, does that mean you're actually getting $100 tax back from the tax office? Well, actually, no. Spending $100 on something that you can claim as a tax deduction will not save you $100 in tax. Essentially, that $100 is still costing you money, but you're just saving an amount of tax which depends on the tax rate you're applying. In reality, it's best if you can get your boss to pay for all your work-related expenses, i.e. you might get reimbursed. Then you don't need to claim a tax deduction, and the full amount has been covered by work. You get dollar for dollar back. But of course, we're not all in the position of where our boss will pay for all the expenses we've had in relation to work. So let's see, we've got a taxpayer here. She's had to work from home and she needs to buy an office chair for her home office to work. So she goes to Officeworks and pays $100 for a chair. And so essentially, it's cost her $100 and $100 has gone to Officeworks. She's using the standard method and this claims a tax deduction of $100 when she lodges her tax return with the ATO. She's claiming a tax deduction of $100 and her average tax rate is 30%. So her average tax rate is 30%. What that means essentially, if she claims a tax deduction of $100, she's saving $30 in tax. And so she's got $30 back from the tax office. That means she's still $70 out of pocket. Because remember, she spent $100 on that chair. Yes, she got $30 tax back from the tax office, but essentially she's still $70 out of pocket. So here you can see how a tax deduction is not giving you dollar for dollar back. It's just saving an amount of tax, and that will depend on the actual tax rate that you're paying tax at. Let's just see how that works. For individuals, our tax payable equals our assessable income, less deductions, minus the tax rate, less offset. Your income less deductions is known as your taxable income. In terms of the rate that applies, for resident marginal people who are resident in Australia, we have marginal tax rates. And what that means is the first $18,200 is tax-free. We pay no tax. Then between the tax bracket of $18,200 to $37,000, the tax rate is 19% for each dollar over $18,200. And then between $37,000 and $90,000, for each dollar above $37,000, we pay 32.5%. The $3,572 you see there is essentially the tax payable on the first $37,000. So with marginal tax rates, the higher rate only applies to the dollar above that rate. So for $90,000 to $180,000, it's $20,000, $797 tax, plus then 37% for each dollar above $90,000. And if your marginal tax rate, if your taxable income is greater than $180,000, then it's 45% for each dollar over $180,000, plus then $54,097 for the tax on that first $180,000. Also, as individuals, we've got to think about the Medicare levy, and that's 2% of our taxable income above a certain threshold for the year. So here, we'll think the taxpayer falls in the bracket of $37,000 to $90,000. So what that means is that the tax on the first $37,000 is $3,572, plus then 32.5% for each dollar above $37,000. So if this taxpayer was claiming a tax deduction of $100, that means it stops $100 of their income getting taxed at 32.5%. So saving them tax of about $32.50. What that means is they're still out of pocket that $67.50. You can compare the value of a tax deduction compared to an offset. So you might get the low middle income tax offset. That's giving you dollar for dollar. For each dollar of an offset you get, it's saving you that amount in tax. So an offset is dollar for dollar, where deduction is less than that. Of course, with any time you're claiming tax deduction, you must keep accurate records about how you claim to that deduction, and you must keep that for a period generally around about 4 to 5 years, depending on exactly your circumstance. It's your onus to keep that. And so if you don't have those records, potentially you'll be denied that tax deduction. Also, don't forget about the Griffith Tax Clinic. The Griffith Tax Clinic is a friendly student-run clinic where you can receive free advice from Griffith University's tax students under the supervision of experienced tax practitioners. The students at the tax clinic may be able to help you with advice regarding a tax matter, how to respond to a notice from the tax office, also how to maybe appeal an assessment that you receive, or maybe to lodge tax returns that you haven't done for the last 5 or 10 years. There's certain eligibility requirements in terms of getting that advice. You currently must be unrepresented, i.e. do not currently have your own tax agent. You must be living in Australia and you must be an individual or a small business entity. If you think you are eligible to apply for free advice, then please go to our website. If you just Google the Griffith Tax Clinic, you'll find our online form where you can fill out an application for free tax advice. The Griffith Tax Clinic, we're here to help. Thank you.